On March 8, 2023, Silicon Valley Bank was the 16th largest bank in America. It held over $200 billion in assets. It was the banker to half of all venture-backed startups in the United States. Tech founders, Fortune 500 companies, and wine country elites trusted SVB with their money. The bank had survived the 2008 financial crisis. It had weathered the dot-com bubble. For 40 years, it was the financial backbone of innovation itself. 48 hours later, Silicon Valley Bank was dead. Not struggling, not merging. Completely seized by federal regulators in the second-largest bank failure in American history. $209 billion in assets, gone. Wiped out faster than Lehman Brothers. Faster than Bear Stearns. This wasn't a slow decline revealed by investigative journalism. This was a bank run in the age of smartphones, where panic spreads at the speed of a group chat and bank accounts empty with a single tap. But here's what makes this story truly terrifying. Silicon Valley Bank wasn't doing anything illegal. There was no fraud, no embezzlement, no rogue trader losing billions on bad bets. Every single investment SVB made was in U.S. Treasury bonds and government-backed mortgage securities, the safest assets in the world. The bank passed its stress tests. Regulators had no concerns. Depositors had no warnings. So how does the most conservative investment strategy imaginable, buying U.S. government bonds, lead to the second-largest bank failure in history? How did technology companies go from cashing checks on Wednesday to panicking about making payroll on Friday? And why did a bank that survived 40 years of boom and bust cycles collapse in less time than it takes to watch a movie? The answer reveals something more disturbing than any fraud scheme. SVB's collapse exposed how the safest investment in finance, lending money to the U.S. government, can become a ticking time bomb. It showed how modern banking operates on confidence so fragile that a single tweet can trigger a stampede. And it demonstrated that the too-big-to-fail reforms after 2008 had created new vulnerabilities that nobody saw coming. What you're about to discover is how a bank built to serve innovators became a victim of the most basic risk in finance. You'll see how safety became danger, how diversification became concentration, and how 48 hours of panic undid 40 years of trust. This is the story of Silicon Valley Bank, a cautionary tale about what happens when everyone makes the same safe bet at the same time. To understand how Silicon Valley Bank collapsed, you need to know the key players who built this institution and the forces that destroyed it. The architect, Greg Becker, served as CEO of Silicon Valley Bank from 2011 until its collapse in 2023. Unlike the Wall Street titans who led banks into the 2008 crisis, Becker was a career SVB employee who'd worked his way up from commercial banking. He understood startups, new venture capital, and built deep relationships in Silicon Valley. Becker positioned SVB as more than a bank. It was a partner that understood the unique needs of tech companies. That specialization would become both SVB's greatest strength and its fatal weakness. The insiders, SVB's leadership came from within. Chief Financial Officer Daniel Beck had been with the bank since 2004. Chief Operating Officer Phil Cox joined in 2001. This wasn't a team of outsiders brought in to shake things up. These were lifers who'd built SVB's model and believed deeply in its strategy. That institutional knowledge created consistency but also groupthink. When problems emerged, there was no fresh perspective to sound the alarm. The clients, Silicon Valley Bank's customer base, wasn't ordinary depositors. SVB served venture capital firms like Andreessen Horowitz and Sequoia Capital. It banked startups from seed stage to IPO, Roku, Etsy, Pinterest, and thousands more. It financed wine country estates and provided mortgages to tech executives. This concentration created incredible efficiencies but also meant SVB's clients all knew each other, shared information rapidly, and could coordinate action in ways traditional bank customers couldn't. The catalyst, the Federal Reserve, led by Chairman Jerome Powell, was fighting the worst inflation in 40 years. Throughout 2022 and early 2023, the Fed raised interest rates at the fastest pace in decades, from near zero to over 4.5%. These rate hikes were designed to cool inflation. Nobody anticipated they would trigger a bank collapse. The Fed was trying to save the economy but ended up creating the conditions for SVB's failure. To understand Silicon Valley Bank's collapse, you need to understand three fundamental forces that shaped modern banking: the aftermath of 2008, the decade of free money, and the unique relationship between startups and their banks. The 2008 legacy. The financial crisis of 2008 changed banking forever. Lehman Brothers collapsed. Bear Stearns failed. The government bailed out massive institutions while letting others die. The lesson seemed clear. Big banks needed more regulation, more capital requirements, more stress testing. Congress passed Dodd-Frank, creating hundreds of new rules for banks with more than $50 billion in assets. But in 2018, something changed. President Trump signed a bill raising that threshold from $50 billion to $250 billion. This exempted dozens of mid-size banks, including Silicon Valley Bank, from the strictest oversight. The argument was simple. These regional banks weren't systemically important. They didn't pose the same risk as J.P. Morgan or Bank of America. They deserved relief from excessive regulation. Silicon Valley Bank actively lobbied for this change, arguing that stricter rules would hurt their ability to serve startups and innovators. The free money era. From 2008 to 2021, we lived in a financial world that had never existed before. Interest rates hit zero and stayed there. The Federal Reserve printed trillions of dollars. Money was essentially free. If you wanted to borrow $1 million, you'd pay almost nothing in interest. This created an unprecedented boom in venture capital and tech startups. Silicon Valley Bank was perfectly positioned to capitalize on this moment. Startups flush with venture capital needed somewhere to park their cash. Tech companies going public needed banking services. Newly minted millionaires needed wealth management. SVB's deposits exploded, from $60 billion in 2018 to nearly $200 billion by 2022. The bank was drowning in cash. This created a problem most banks would love to have. When deposits flood in, banks need to do something with that money. They can't just let billions sit idle earning nothing. Traditionally, banks make loans, mortgages, business loans, auto loans. But SVB's startup clients didn't need traditional loans. They were raising equity, not debt. So SVB did what seemed safe. They invested heavily in U.S. Treasury bonds and mortgage-backed securities guaranteed by the government. The duration mismatch. Here's where the danger hid in plain sight. When you deposit money in a bank, you can withdraw it any time. That's a short-term liability for the bank. But when a bank buys a 10-year Treasury bond, that's a long-term asset. This mismatch between short-term liabilities and long-term assets is normal in banking. It's how the system works. The problem is interest rate risk. When SVB bought Treasury bonds yielding 1.5%, they were safe as long as those bonds were held to maturity. But if interest rates rose sharply, those bonds would lose value if SVB needed to sell them before maturity. Think of it this way. If you bought a bond paying 1.5% and rates rise to 5%, nobody wants your old bond. They'll buy new bonds paying 5%. Your bond's market value drops. SVB believed interest rates would stay low forever. The Federal Reserve said rates would stay near zero through 2023. Inflation seemed under control. The bank built a portfolio of long-term bonds assuming rates wouldn't rise significantly. They were betting the entire bank on this assumption. The network effect. Silicon Valley Bank wasn't just concentrated geographically, it was concentrated socially. The bank's clients all knew each other. They attended the same conferences. They had group chats and shared Slack channels. Venture capital partners talked constantly. When information moved through this network, it moved fast. When fear entered this network, it spread like wildfire. Traditional banks have millions of dispersed depositors who don't coordinate. SVB had thousands of highly connected, sophisticated clients who could act collectively in minutes. The golden years, 2010 to 2021. Silicon Valley Bank spent a decade living the dream. As tech boomed and venture capital exploded, SVB became the go-to bank for innovation. The bank understood startup economics in ways traditional banks didn't. They knew that early-stage companies burned cash and wouldn't be profitable for years. They offered specialized services, venture debt, lines of credit tied to fundraising rounds, relationships with investors that could open doors. This specialization paid off spectacularly. Between 2019 and 2021 alone, SVB's deposits nearly tripled, from $71 billion to $189 billion. This wasn't gradual growth. This was an avalanche of cash flooding into the bank as tech startups raised record amounts of venture capital and then deposited that money with SVB. The bank's investment strategy seemed prudent. Take all these deposits and invest in the safest assets possible: U.S. Treasury bonds and government-backed mortgage securities. No crypto. No derivatives. No subprime mortgages. Just boring, government-guaranteed bonds. CFO Daniel Beck emphasized this strategy in earnings calls, presenting it as conservative and low risk. Regulators had no objections. This looked like textbook safe banking. But underneath the surface, a dangerous concentration was building. By 2022, SVB had invested over $120 billion, more than half its assets, in long-term bonds yielding around 1.6%. These bonds wouldn't mature for years. If interest rates stayed low, this was fine. If rates rose sharply, those bonds would lose value. But the Federal Reserve kept promising rates would stay near zero. Inflation seemed transitory. The bet seemed safe. The gathering storm, 2022. Everything changed in 2022. Inflation surged to 40-year highs. The Federal Reserve pivoted from promising low rates to hiking aggressively. In March 2022, the Fed raised rates for the first time in years. Then again in May, and June, and July. By December 2022, rates had risen from near zero to over 4%. This was the fastest rate hiking cycle in 4 decades. These rate increases destroyed the value of SVB's bond portfolio. Remember, SVB held over $120 billion in bonds yielding 1.6%. Now new bonds were yielding 4% or more. SVB's bonds had lost billions in market value. On paper, the bank was sitting on massive unrealized losses, bonds worth far less than SVB had paid for them. Here's the crucial detail: these were unrealized losses. As long as SVB held the bonds to maturity, they'd get their money back. The losses only became real if the bank was forced to sell the bonds early. And why would they need to sell? Well, if depositors started withdrawing money faster than expected, SVB would need cash. They'd have to sell those underwater bonds, turning paper losses into actual losses. And that's exactly what started happening. As interest rates rose, startups faced a brutal new reality. Venture capital dried up. Tech stocks crashed. Companies that had raised money at billion-dollar valuations suddenly couldn't raise follow-on rounds. They started burning through their cash that was sitting in Silicon Valley Bank. Deposits that had flooded in during the boom years started flowing out. Between mid-2022 and early 2023, SVB lost over $15 billion in deposits. The bank tried to manage this quietly. In late 2022, SVB began selling some bonds to raise cash, locking in losses. But they convinced themselves this was manageable. The startup winter would end. Deposits would stabilize. They just needed to weather the storm. The breaking point, March 8 to 9, 2023. On March 8, 2023, Silicon Valley Bank announced it had sold $21 billion in securities, realizing a $1.8 billion loss. To shore up capital, the bank was raising $2.25 billion through stock offerings. The message was meant to be reassuring: we're proactively managing our balance sheet, strengthening our position. The market reaction was panic. SVB's stock plunged 60% in a single day. Venture capital firms started receiving worried calls from their portfolio companies. Group chats lit up with concern. The tight-knit network of Silicon Valley founders and investors began sharing information rapidly. Questions multiplied. Is SVB in trouble? Should we withdraw our money? What if there's a run? That evening, several prominent venture capitalists made a fateful decision. They advised their portfolio companies to pull money out of SVB. Peter Thiel's Founders Fund reportedly began withdrawing funds. Other VCs followed. What started as caution accelerated into fear. By Thursday morning, March 9th, the stampede had begun. The numbers tell the story of catastrophic velocity. On Wednesday, SVB clients requested $42 billion in withdrawals, nearly a quarter of the bank's total deposits in a single day. By Thursday morning, the queue had grown to over $100 billion. The bank that had $200 billion in deposits on Tuesday morning was facing withdrawal requests for half that amount by Thursday afternoon. There was no way to meet this demand. SVB would need to sell its entire bond portfolio at massive losses. Even then, it might not be enough. The seizure, March 10, 2023. Friday morning, March 10, Silicon Valley Bank opened for business as usual. Within hours, California regulators shut it down. The FDIC took control, seizing all assets. SVB's website went dark. Branches closed. The 16th largest bank in America ceased to exist 40 years after its founding. The human impact was immediate and severe. Thousands of startups suddenly couldn't access their money. Companies with millions in SVB accounts couldn't make payroll. Roku disclosed it had nearly $500 million stuck at SVB, 26% of its cash. Roblox had $150 million trapped. Circle, the company behind USDC stablecoin, had $3.3 billion at SVB, triggering a mini-crisis in cryptocurrency as USDC briefly lost its dollar peg. The weekend saw frantic negotiations. Startup founders faced impossible decisions: tell employees they might not get paid, or try to find emergency funding while banks were closed. Venture capital firms scrambled to coordinate responses. The tech industry, usually confident in its ability to innovate through any problem, faced an old-fashioned banking crisis with digital age speed. The government response, March 12 to 13, 2023. The federal government faced a dilemma. Silicon Valley Bank wasn't technically too big to fail by the post-2008 standards. It wasn't a global, systemically important bank. But letting it fail would be catastrophic for the tech ecosystem and could trigger runs on other regional banks. Sunday night, March 12, the Treasury Department, Federal Reserve, and FDIC announced an extraordinary decision. All SVB depositors would be made whole, even those with balances exceeding the FDIC's $250,000 insurance limit. The government wasn't bailing out SVB's shareholders or bondholders; they were wiped out. But depositors would get all their money back. The government also announced a new program, the Bank Term Funding Program, allowing banks to borrow against their bond holdings at par value rather than depressed market values. This was designed to prevent other banks from facing SVB's fate. The decision was controversial. Critics argued this was a backdoor bailout, protecting wealthy tech companies and their founders. Supporters said it was necessary to prevent broader financial contagion. Either way, it revealed an uncomfortable truth: the government would step in to protect depositors at banks serving powerful industries, regardless of the stated rules. Silicon Valley Bank's collapse echoes through financial history, repeating patterns we've seen before while adding distinctly modern elements. The S&L crisis redux. In the 1980s, savings and loan institutions faced a similar duration mismatch problem. S&Ls had made long-term fixed-rate mortgages when rates were low. When the Fed raised rates to fight inflation, those mortgages lost value and depositors withdrew funds to chase higher yields elsewhere. Over 1,000 S&Ls failed. The causes are nearly identical to SVB: interest rate risk, poor asset liability management, and regulatory gaps. Yet 40 years later, we repeated the same mistake. The modern bank run. What's different this time is velocity. In the 1980s, bank runs took weeks. During the Depression, they took days. SVB collapsed in hours. Mobile banking apps let depositors withdraw millions with a tap. Group chats and social media accelerated coordination. When Founders Fund reportedly pulled money, other VCs heard instantly and acted. This is the bank run reimagined for the digital age. Faster, more coordinated, more deadly. The concentration problem. SVB's clientele was so interconnected that diversification became meaningless. Traditional banking wisdom says geographic and industry diversification reduces risk. But when all your clients know each other, talk constantly, and act in coordinated ways, that diversification provides no protection. Credit Suisse faced something similar in March 2023, as wealthy clients coordinated withdrawals. First Republic Bank followed SVB into failure weeks later, suffering the same connected client death spiral. The 2008 parallels. Like 2008, SVB's collapse revealed regulatory blind spots. The 2018 rollback of Dodd-Frank exempted SVB from stricter oversight. The bank's CEO Greg Becker had personally lobbied for this relief, arguing SVB wasn't systemically risky. The collapse proved this wrong. SVB's failure required government intervention just like the 2008 banks. We created too big to fail regulations, then exempted banks that turned out to be too important to fail anyway. The continuing problem. As of 2024, hundreds of banks hold similar underwater bond portfolios. They face the same interest rate risk SVB did. Most have stabilized as the Fed stopped hiking rates and deposit flight slowed. But the fundamental vulnerability remains. Many regional banks are sitting on unrealized losses that become very real if depositors panic. SVB wasn't an anomaly, it was the most dramatic example of a systemic issue. The question isn't whether conditions could create another SVB. It's whether we'll recognize the warning signs before the next 48-hour collapse. So what should we learn from watching a 40-year-old bank disappear in 2 days? First, safety is contextual, not absolute. U.S. Treasury bonds are the safest investment, except when they're not. SVB made the most conservative investments possible and still failed. The problem wasn't the assets but the mismatch between those assets and the bank's liabilities. In finance, safety depends on having assets that match your needs. A 10-year bond isn't safe if you need money tomorrow. Second, concentration is vulnerability disguised as efficiency. SVB's specialization in tech made it incredibly profitable during the boom. That same specialization killed it when conditions changed. When all your clients know each other and can coordinate, diversification doesn't protect you. Network effects work both ways. They amplify success but also accelerate failure. Third, speed changes everything. The financial system has frameworks for slow-moving crises. We don't have frameworks for crises that unfold in hours. SVB faced a classic bank run, but social media and mobile banking compressed what used to take days into mere hours. Our regulatory responses, safety nets, and crisis management protocols aren't built for digital speed panic. Silicon Valley Bank held $209 billion on Wednesday. By Friday, it was gone. That shouldn't be possible. The fact that it was should terrify anyone with money in a bank. If this deep dive into financial fragility was valuable, subscribe to Financial Chronicle. We're examining the systemic risks hiding in plain sight and the crises that nobody sees coming until it's too late. What financial time bomb should we investigate next? Share your thoughts below. The question isn't whether another bank will collapse in 48 hours. It's whether we'll recognize the warning signs, or whether we're all too busy tapping withdraw to notice until it's too late.